While equities have been relatively stable in recent weeks and have maintained gains of close to 8% year-to-date in local currency terms and 11% in euro terms, bond markets have been much more volatile over the last month, with European and global yields rising significantly. Currencies have also experienced some change in trends, with the euro strengthening to just over 114 against the US dollar at one point, as expectations for the timing of the first US interest rate rise were pushed out to late 2015. But in recent days, the euro has weakened again to 109 versus the dollar, as the ECB reaffirmed its commitment to looser monetary policy through its intention to complete its asset purchase programme, and some improvement in US economic data following softer releases earlier in the year. Following a consistent trend of falling yields in bonds in recent years on the back of falling inflation and central bank purchases of bonds, bond yields began to rise in mid-April, as can be seen in the chart. Having reached an all-time low of 5 basis points, in the space of a couple of weeks, German 10-year yields rose to a recent high of 78 basis points, a relatively unprecedented rise in such a short period of time. What contributed to the turnaround was a belief that the threat of deflation across the Eurozone had been removed, with a move back from an inflation low of -0.6% year-on-year in January to a flat inflation reading in April. The rebound in oil prices from a January low of $47 a barrel to $67 a barrel in early May also led to a rise in future inflation expectations. The liquidity and demand supply dynamics within the Eurozone bond market also deteriorated through late April and early May. Over the course of the ECB's bond buying programme out to September 2016, on average, the ECB will buy €20 billion more bonds per month than are issued on a net basis by Eurozone governments. In May, however, due to unusually large issuance, net supply of government bonds will exceed ECB buying by approximately €30 billion, even with the front-loading of purchases recently announced by the ECB. Thus, the combination of higher inflation expectations and poorer demand-supply dynamics in a market in which many investors were long of bonds led to a significant bond sell-off in a market where liquidity was tight. We believe the recent sell-off in bonds and rise in yields is probably overdone in the short term. While inflation across the Eurozone is likely to rise in coming months, it is only expected to be running at a stable rate of around 1% through 2016, well below the ECB's target of 2%. In such an environment, the ECB is likely to continue to be a large buyer of sovereign bonds and could possibly look to extend its current asset purchase programme beyond September 2016, either in terms of size or length of time. On a fundamental basis, the rebound in oil prices also appears overdone, with supplies of oil continuing to exceed demand as production levels year to date have increased not only in the US but also in OPEC countries, and US inventories are running close to all-time highs. With further potential additional supplies from Iran later in the year, if the proposed nuclear agreement is signed, and with the recent rebound in oil prices likely to result in a recovery in US oil production investment in the second half of the year, we believe oil prices are likely to decline again, which would ease some of the recent rise in inflation expectations. While bond yields can decline in coming months, towards year-end and into 2016, there could be renewed upward pressure on yields again, as Eurozone growth continues to improve, so that in 2016, German 10-year yields settle close to current levels of around 0.5%. Greece remains an issue for markets and crunch time is approaching as Greece is set to run out of money in early June. Given the negative consequences for the Greek economy in the result of a failure to reach an agreement, we believe a compromise will shortly be reached, but markets will remain sensitive to these developments. After some strength through April, we believe over the remainder of the year and into 2016, the euro will continue to weaken against the dollar as US interest rates finally begin to rise, while at the same time the ECB is expected to continue to run loose monetary policy through its asset purchase programme, and believe parity against the dollar is likely through late 2015 and early 2016. Global equity markets, we believe, still provide upside, supported by accommodative monetary policies from central banks, relatively attractive valuations compared to other assets, and a modestly improving economic backdrop, which we expect to improve through the remainder of the year, following surprisingly lower growth in the first quarter.